Good evening and welcome everyone to this exciting session. Today we have with us the entire Ambit team. Ambit Asset Management is a name to reckon in the industry with a great track record on a lot of their portfolio management strategies. And today we have with us Mr. Sushant Bansali, we have Mr. Siddharth Rastogi, uh, we have Mr. Manish Jain with us, and we have Mr. Aishwarya Dadich. I welcome all of you on behalf of Prabhudas Lilladher to this session, Ambit's team. And to begin with, guys, we will start with Mr. Manish Jain, who is the fund manager of Coffee Can Portfolio Strategy. Mr. Manish is an MBA and has more than 17 years of experience in investment management industry. And previously, he has worked with Nomura, Lehman Brothers, ICICI Securities, Motilal Oswal, and had been covering a lot of sectors, including consumer sectors. So, without much ado, I'll hand it over to Manish. Manish, the dice is all yours to take us through your strategy.
Thank you so much and welcome everybody. Really obliged that you guys took time out of your busy schedules to hear us out. So if you look at Coffee Can, and I'll try to keep it short, about 5 to 7 minutes, not more than that, before I hand it over to Aishwarya. Very simply put, Coffee can be summed up in two simple words. Number one is consistency, and number two is safety, right? Now, if you look at the returns of Coffee Can in the last 4 years that we've been in existence, and I would take you through the returns on a year-by-year basis, calendar year by calendar year basis, dare I say that you'll probably not find any other fund which is as consistent as Coffee Can is. We've delivered double-digit returns year after year, every single year for the last 4 calendar years now. Starting with calendar year 2017, we had 28% returns. Calendar year 2018, when we had somewhere close to 15% return. Calendar year 2019, when we had close to 19% returns. And calendar year 2020, when we had close to 22% return. So the compounded return on a since inception basis stands at close to 20% or thereabouts, right? So while the economy has undergone a massive amount of turmoil, and there has been significant ups and downs in the market because of the COVID crisis. Before that, our GDP was massively slowing down. Before that, the auto sector crisis, was on our head. Before that, there was this whole ILF's bust up which had happened. And before that, there was this whole, GST implementation crisis which was happening. And through all of this, Coffee Can has been able to deliver, and not just deliver returns in absolute terms, which is what we try and focus on, because we are an absolute return product. We are an absolute return strategy, where we try to deliver these consistent 15%, 17% kind of returns year after year, every single year, irrespective of the prevailing macro, the microeconomic conditions, right? But we have outperformed the benchmark also, and by a good 7-8 percentage points on a since inception compounded basis, right? So here it is. If you look at it, this is a slide I was referring to, the chart below. Almost close to a 7 percentage points outperformance as compared to the benchmark index. So this is a kind of consistency that we are talking about. And if you break down the same returns on a quarterly basis, then you'll realize there is one thing which is common across all the three fund of ours, is safety. Every time the market has actually hit a bad patch, we have always outperformed the market, and we have always protected the capital as far as the index is concerned, as far as the fund is concerned. Now, the proof of the pudding is in the eating. The worst quarter that the Nifty has faced, arguably, in the last 5 or 6 years has been Jan to March of last year, 2020. And if you look at Coffee Can as a fund at that point of time, when the market was down about 28 or 29%, we were down only about 13%. And this is something that we have done year after year, every year, and quarter after quarter, every quarter. We have protected the capital of people, right? And through that, we have also generated steady returns across periods of time. So if you have to position Coffee Can, then very simply put, it stands for 3 or 4 very simple things. One is that we are not in the game of trying to outperform the market month after month, every single month. Uh, we are not afraid of trying to underperform the market intermittently if that is what it takes. We always try to stick to the philosophy 100%, never deviating away from it, because we believe you don't sell stocks to people, but to your customers. You sell a thought process. You sell a philosophy, and if you deviate away from it, then there is nothing left, right? So when you give your word, you kind of stick to it. We never deviate away from the basic of the coffee can philosophy, and we never compromise on corporate governance standards, right? Uh, so if you have to pitch Coffee Can, who is an ideal customer for Coffee Can? Ideal customer for Coffee Can is a guy who's patient, long-term investor, has an investment horizon of at least minimum 3 to 5 years. Number one. Number two is a kind of a guy who has low risk appetite, yet wants to invest in equities. A kind of a guy who's happy with steady returns, but is looking at wealth creation and not income generation. A kind of a person who's going to leave the money for long term, only to see it multiply by 15 to 20% year after year, every year, over long periods of time, to make it 6 to 7x in 10 years, around 30x in 20 years, right? Somewhere close to that. That's a kind of a customer that you look at Coffee Can, and somebody who has a very specific need for investing. And need for investing can be categorized in two ways. One is a very specific, aim-driven investing, which is that you are in your early 20s, you want to build up a corpus for your marriage. You are in your 30s, you're married, you have kids, now you're wanting to, garner funds for your children's education or maybe their marriage. You are in your 40s, 50s looking to plan for your retirement. You're in your 60s looking to plan for your generational wealth transfer. Those are the kind of people who are ideal customers for Coffee Can. And second kind of people are people who are ultra high net worth, ultra HNIs, who have so much money, ideally a net worth of upwards of 5 crores plus, who can leave 50 lakhs or so invested in a single instrument and forget about it from a 2 3 year perspective, right? And not really track it from a long term perspective. So those are the two kind of people you should position it for. What are the 5 basic principles of Coffee Can? Very briefly to take you through them. Number one is long-term investing. Now, this is something that I referred to already earlier. 3 to 5 years is a minimum time frame that we ask people to invest in us for. But when we invest in a company, we ideally invest from a 10-year perspective. We take a really long-term view. Second is, it's always going to be a very concentrated portfolio. We try and hold anywhere between 10 to 15 stocks, not less than 10, not more than 15. The idea is to concentrate more on the depth of research rather than the breadth of the portfolio. We do not try to tick any boxes. We do not try to diversify just for the heck of it. We do not try to de-risk ourselves. And the weight should be substantial enough for every single stock to make a difference in the portfolio. Third is low churn. The churn in Coffee Can is always going to be less than 10 to 15% at any given point of time. We really believe in long-term holding. If you look at the last 4 years, our churn ratio has been around 5% to 10% or thereabouts, not more than that. We have sold one single stock. We have bought 4 or 5 new, and that's pretty much all what we have done. And fifth, more important, is corporate governance. We are obsessed with it, not just the company in question, the group companies or promoters in their private ventures, etc., etc. But we promise you one thing, that we are never ever going to pick a wrong stock, right? And that is a commitment that we've made to ourselves. That's a commitment we've made to our investors, and across all 3 funds. We are never ever going to pick a wrong stock. And fifth and last is B2C companies. We try and invest as much as possible in B2C companies, because the idea should be to invest in the markets for as long as possible rather than trying to time the market. And B2C companies are the ones that have the power of brand equity with them. They can leverage that to generate consistent profit growth year after year, so that you don't have to lose your sleep. So if you do not want to lose your sleep, if you want to have a good night's rest, if you want to see your money multiply, wealth being created, enormous amount of wealth being created over a long period of time, and yet do not carry any risk on your head, then Coffee Can is the most ideal product. With that, I will stop my pitch here, and I'll hand over the floor to Aishwarya to take you through Good and Clean.
Thanks a lot, Manish, for the insightful presentation. A very short and crisp model, and we really love the way you presented it. There is a solid outperformance of this strategy on the back of a really very strong philosophy and the investment process you follow. And an important point you made was the consistent approach. That's very important when we are managing public money. So, with this, thanks a lot for your session. And now I invite Mr. Aishwarya Dadich to present his strategy, which he manages, which is good and clean strategy. Mr. Aishwarya Dadich has more than 12 years of experience in Indian equities, and he had been managing a lot of strategies in his previous roles with Reliance Life Insurance and CRISIL. He's a CFA and a CA and an MBA. So over to you, Aishwarya.
Thank you, Piyush, and good evening, everybody. I believe Manish has done a phenomenal job of explaining the strategy here. And at Ambit, we follow the strategy that is there. The edifice of every strategy is more or less same. So when Manish said that we look out for two most important thing in coffee can, which is consistency and safety. In the fund which we manage here at Ambit Good and Clean Midcap Fund, we just look out for one more important characteristic, which is scalability. So what are we doing here at Ambit Good and Clean Midcap Fund is trying to find out those good and clean midcap companies today, which possibly can become the large cap of tomorrow. And how we're going to do that is very simple. We are looking for those businesses run by people of high integrity, high competence, high standing, where we believe that they have the whereabouts to become bigger and bigger over a period of time. At the same time, they have shown consistency in the past, maintaining the safety around our investment. So that is what the fund is all about. The fund is based on a clear-cut strategy of finding those businesses who are efficient capital allocators. So what do I mean by efficient capital allocators is, which is all the good part of the portfolio indicate, is whether these businesses are able to generate high ROEs, right? And at the same time, since we invest into mid caps and small cap, we have to be very sure on the corporate governance of these businesses and also on management ability and how they're reporting their numbers and all that. So we also spend a lot of emphasis on the forensic accounting of the businesses that we are looking to invest. So in nutshell, what are we trying at the cost of repetition? In nutshell, we're trying to find out businesses which are small today who have the trait to become the large caps. And we believe that is the best way to create wealth. So in short, what are we doing here is we're trying to find out the next coffee can companies, right? Which will become coffee can companies in the next 3 years, 5 years, or a 10-year period of time. Now, if you really look at two interesting things I want to highlight it. First of all is what juncture we are standing from the economic perspective as well as the market perspective, and which segments are possibly going to do well over the next 2-3 years is of paramount importance. Second is how this strategy has fared well. So we'll briefly touch on the second part before we go on and discuss slightly more on the juncture where we are standing right now. On the performance bit, this strategy has been working really well. If you can see on the presentation being shown, first of all, this product has completed 6 years in this month of March 2021. And I would say the last 6 years, especially the last 3 years, were the toughest, at least for the mid caps and the small cap companies there. So if you really look at in the last 3 years, the mid cap index is a Nifty Mid Cap 100 has given a return of 5.8% CAGR, right? This is despite we have seen such a strong momentum which has happened in the market in the last, say, 4 or 5 months. Compared to that, this portfolio has given a return of 16.2%, almost, more than 10-11% positive alpha being created. And look at last 5-year return of almost 21% compared to 15%. And in the last 6 years, we've been able to generate almost 14.3% return, roughly 5%, 4.5%, 5% higher than the indices. And how we have been able to do this is very simple, that our intent is always to find out businesses which are fundamentally very strong, both from the way they conduct business in the form of high and strong leadership position, strong pricing power that they have, Second is that possibly they have a very strong balance sheet, good management, but at the same time, we believe that those businesses who can really become big, they should be the beneficiary of the formalization which is taking place in the economy over the last 2 3 years. The consolidation which was getting pace after GST and possibly also getting a lot of pace after COVID. So those players which in short can become large caps, and that is what we're trying to intend here. Separate again, we don't treat this as a very tactical portfolio. This is more like buy and hold businesses for a long period of time with a very limited churn. Right, the churn of the portfolio would be around 15 odd percent. It's a pretty concentrated portfolio of 16, 17 businesses that we have in our portfolio, and I can tell you the quality of the portfolio from debt equity side, from the ROE side. To just share you some numbers, the debt equity of the portfolio would be around 0.3, 0.4 times, and for an ROE of almost 18%. If you look at FY20 or 19 number. So at the same time, the growth prospect, whether it is the earning growth or the PAT growth, you can look at it in the table in front of you. The revenue growth has been around 15% for the last 5 years, compared to Nifty Midcap 100 of -3%. And look at the PAT growth of 13% compared to 4%, and ROE, which I was talking about, 18% and 17% compared to 4 and 8%. For this is a comparison to Nifty Midcap. Compare it to Nifty 50, even the ROE is almost 6% higher than the Nifty 50's ROE. So in short, this portfolio is the one which is not only growing faster, but obviously have a high ROE, strong balance sheets, lower debt equity, and which all help us into limiting the drawdowns during tough times. And that is what I believe is the magic mantra here. So when you look at the Sharpe ratio, which obviously indicates that how favorable the risk reward is on that side, and this has a beta of almost 0.8%. Compared to conventional. So in short, this is a very moderate risk profile portfolio, which suits for an average moderate risk taker, and where we believe that this portfolio can be able to create wealth over a long period of time. Now, coming back to the point number one, when I was indicating that why this portfolio looks pretty interesting at this juncture of time, because what we have been seeing in the market over the last, say, 1 year or so, we are seeing that polarization toward large cap is unwinding. We are seeing that economy, which has been under stress, is coming out gradually out of the blues. What are we seeing is that possibly we will see a stronger economic, stability over the next 2 to 4 quarters, stronger earning growth, and most likely the interest rate, which has been there at a lower level for the last 9-10 months, will probably stay here at this level for at least 8 to 9 or 10 months. Then the probability of this kind of names, domestic cyclicals or rate sensitive or mid caps and small cap, to do materially better over the next 2 years is very, very high. And that's why we believe that this plays a very this acts as a great solution to that problem, and probably will act great if someone increase their allocations toward quality mid cap and small cap in the portfolio, which will help them to generate slightly better alpha creation opportunity over the next 2 years. So I think I have summarized this thing, but yeah, only thing worth highlighting is that this is not a pretty tactical portfolio, in the sense this is not momentum based. This is not we don't do too much of churn. This is not like buying and selling on cyclists. So we don't invest into high debt companies, high levered companies that way. We are more on finding secular earning growth story, which help us to create wealth on the power of compounding. So I think with that, I will stop here. We're already at 4:30. I will invite now Zubin to spend some quality time on the insurance sector, and possibly then we can discuss in better detail about any other questions that you might have. Over to you, Zubin.
So before I get into a portfolio company of ours within the life insurance sector, I would just like to just take some time talking about the life insurance sector, because this sector is generally quite complicated in terms of understanding. So in order to make things easier, I would try to basically talk about how the sector has moved and what are the key rationales why we have chosen an insurance company in our portfolio. So the Indian life insurance industry, it was basically opened up to the private sector sometime in 2000. And in those 2 decades since, so we've seen that it has grown it has actually shown multifold growth. However, the industry has gone through numerous cycles. So structural changes in the economy have resulted in positive flows towards financial assets, which has aided the insurance industry. A large number of private players had entered the industry sometime close to 2000. Prior to that, the insurance industry was only dominated, or rather, there was a monopoly of only life insurance Corporation of India. So currently, we have close to 24 players, which includes LIC. And LIC has been losing market share to the private players once the private players were allowed to enter. So now talking about the various cycles within we've seen across the last 20 years. So the early part of the cycle is basically, we can characterize it as more towards growth and increasing market share. So when the private players entered or were allowed to actually sell insurance, their focus was mostly or majorly towards increasing the growth and increasing market share. So they had very little emphasis towards profitability. So this basically resulted in close to 33% CAGR from FY02 to '07. So this was the actual growth in terms of the annualized premium. And key reason for that was their focus towards ULIPs. So as you are aware that ULIP as a product is uh, basically as a product, it invests some amount towards the capital market, and only a small quantity, or let's say about 40% or to close to 50%, is kept as term insurance. So these products gained quite traction because the economy was performing quite well. And that's the reason we were seeing that the private players were able to actually report good numbers in terms of new business. So once the post FY07, so basically sometime in FY09, with there was a sharp turn, or basically a slowdown in terms of the macro environment, and the capital markets gradually became to weaken. And the APE growth that was seen during that time was close to 4%. So we had a period where we saw 33% growth, but now we had a period where we are seeing only 4% growth. So because of this, the life insurers, the private life insurers understood that running behind sales or growth in terms of market share should not be the important criteria, but looking at profitability should also be a key criteria. And that is when the uh, basic structure or the basic outlook for all these private insurers started to change. And they started focusing more and more on these high margin products in terms of a pure term insurance, or in terms of a non-par saving products. So these kind of products are basically high margin products for life insurance, because all the amount that these companies receive is kept or is basically invested. Whereas in a ULIP, you have to only a small component of it is basically moves towards a term insurance. So that's how we characterize the last 20 years in terms of the life insurance industry, where we first had a high growth phase, then we had a phase where there was very minimal growth or close to single digit growth. And now we are seeing all these companies, all the private companies, focusing more on profitability and moving more towards increasing protection as a product. If you could move to the next slide. So talking further about, as I mentioned, that there are close to 24 players, which includes LIC. The key thing to notice out here is in the bottom graph, where we're seeing basically that there was a time where once when LIC used to dominate the market because of its monopoly, but slowly, we are actually seeing that the market share of private players, it's increasing, and they're able to take some market share from LIC. And because LIC has such a huge base as well as such a huge manpower, it is able to withstand some pressure from the private players. But because of the digital initiatives as well as the strong bank assurance that they have in terms of distribution, they are able to gain certain market share from LIC. And as you can see in the bottom right side, where this graph basically says that those insurers which have a strong bank assurance partners, they are able to perform well or have been performing well. So close to within the private players, the top 5 to 6 players are the key dominant players, and they have very strong bank assurance partners. So for example, ICICI Life has got ICICI Bank. You have HDFC Life, which is being supported by HDFC. You've got SBI Life. Now you have Max Life, who's also got support of Axis Bank with the 20% deal now done, close to 19% deal being done. So you have such strong private banks which are basically supporting these private players, and that is why these particular private players have been able to perform quite well. And another key component to look at is their focus towards digital as a distribution. So the direct channel, basically, which includes the online, it has been gaining quite traction over the years, and it's actually shown faster growth as compared to all the other channels. If you all have a look, so increasing digital awareness coupled with the government's push towards digitization is helping the online channel emerge as a key distribution channel. The insurers are also trying to tie up with partners within the non-traditional ecosystem. So you'll have insurers who are basically tying up with Airtel, or you have insurers who are basically trying to tie up with Paytm. You have companies which basically help in terms of increasing the premium. And these are certain new age digital distribution systems which are coming up. And these are certain key factors which will help all the private players, if this partnership is successful, to gain much more market share from LIC. Umang, if you could move to the next slide, please. So as I spoke earlier, that we have an insurance company, life insurance company in our coffee can portfolio. So we have basically selected HDFC Life, or we have chosen HDFC Life. And here are certain key rationales, investment rationales. So I'll be talking about each of it in the subsequent slides, but certain key factors which basically helps HDFC Life stand out with respect to its other peers. First being its consistent premium growth. And this premium growth has led it gain market share within the private industry. So it's a key component wherein we are seeing that new business premium. So new business premium is nothing but premium which which life insurers get from new clients, basically new business. So we have seen consistent new business premium growth for HDFC Life. Second factor is its focus towards shifting more towards high margin products. So as I mentioned that the industry basically was more focused towards ULIPs, where ULIP is more savings oriented. But HDFC Life, from the very beginning, it actually tried to focus more towards high margin products such as term insurance as well as non-par products. These products basically help them drive margins, and that's a standout point if I have to compare HDFC Life with all its private peers. Another key component is its focus towards having a diversified distribution channel. So it is not only dependent on HDFC Bank, but it's also looking to increase its different share within the other distribution channel. So it's focused more towards online channel. It's focused towards its own agency channel. So as we proceed, you will be able to see how it's basically able to diversify, and that gives us comfort that if in case HDFC Bank decides to, let's say, has some difficulty in terms of pushing HDFC Life's product, so there will be other channels which will be able to support. Fourth factor is something called as an embedded value. So this is a technical term we use in the life insurance space. I'll talk about it as we proceed. And fifth point would be the strong balance sheet that they have, and they've got comfortable solvency position. So they are, as compared to a requirement of about 150%. So currently they have close to 207 to 208% solvency position right now. So that gives quite a strong comfort in terms of the balance sheet. And the sixth and a structural point being the high under penetration within the insurance market. Uh, Umang, if I could just so first I'll talk about the structural support. So as you all know, the insurance penetration rate in India is quite low. It's close to about 3%, as compared to, if I look at the world average, it's about 3.3%. This rate in the penetration level in India was close to about 5% sometime in 2010. Again, that was because of high number of sales in the ULIP, but that gradually decreased because there were certain regulatory guidelines which were implemented, which basically put a cap on all these ULIP charges, and there was a certain cap on discontinuation charges, and where basically all the mis-selling was curbed by the regulations introduced by IRDI. So because of these particular regulations, we saw that the second phase showed low growth, where I spoke about 4% CAGR growth in terms of premium on an annualized basis. But HDFC Life was first in terms of moving more towards protection. Second key component or an important graph I would like to talk about is the protection margin or the protection gap on the top right. So what that basically talks about is, it basically talks about the difference between the resources that families have, and those they might need in order to maintain to maintain their living standards if in case there is a death in the family. So if, let's say, you all spend about 100 rupees a month right now, and if there is a death, so you all would be requiring, let's say, close to 100 rupees. But this basically, this graph shows that the insurance that we take, or rather the term insurance that we take, is quite minimal as compared to what is required. So this, as I'm talking about the protection gap, which states 83%. So this basically says that if in case there is a death in the family, and if there's a requirement of rupees 100, so we've taken insurance policy for only rupees 17, and 83 rupees is still left in order to maintain the life that we used to maintain before the death of the family. So this is what the graph talks about. Another key point is this is the highest in terms of the entire all the countries across the globe. So this basically points out to the huge under penetration that we are seeing in terms of an insurance or a life insurance product. Another key component, or rather factor, which would be quite helpful for life insurance companies, is that India is the world's second most populous nation after China. More importantly, it's a nation of mostly young people. So we had close to about 350 million people in the age gap of about 10 to 24 years age. And nearly this is close to, if I have to talk about in terms of facts, so 87 million more than people in China. This is a report of a UN report sometime in 2014. So looking at these factors, which going forward, the UN basically predicts that the share of population within the 15 to 59 age group category is going to increase to 63% by 2022, from the 62% that we're seeing in 2011. So for life insurance companies, this is quite a compelling opportunity, with adding the under penetration and the age gap that we're seeing, and the age group that we're seeing within the country. This is a quite a compelling opportunity for life insurers to step in, and that is why we feel that investing in a life insurance company with this structural support is quite a win-win situation for the coffee can portfolio. Uh, Among, if you could, the key points where I spoke about premiums. So these are the figures which I'm comparing for all the four private listed players here. So we have HDFC Life, we have SBI Life, we've got ICICI Prudential, and we've got Max Life. So as you all can see, in terms of the new business premium, so that is basically new premiums every year. So HDFC Life is, if I look at if I look at a 4-year CAGR, so HDFC Life has performed has shown a 28% CAGR as compared to SBI Life at a 24% CAGR, ICICI at a 16% CAGR, and Max Life at an 18% CAGR. So HDFC Life, because of its new business premium growth, has consistently gained market share in the private market as well as in the overall industry. As you can see in the chart below, where HDFC Life has been able to garner market share not only from LIC, but has also been able to garner market share within the private industry. So a key component, if I try to dig deep, so we have certain components wherein all these life insurers sell insurance to individuals as well as to group companies. So the group new business premium, it has grown at a faster clip than individual new business premium. And owing to this, HDFC Life's market share in the group business has grown from 14% to 28% in FY20. And this has been a key driver for HDFC Life. So this basically shows that while the other insurers are focusing more towards retail side by selling ULIP as a product, HDFC Life has actually tried to diversify in terms of the products that it's offering, and is also looking at group businesses. So it's also trying to gain market share from LIC, which is a dominant player in the group business. And that is where we are trying to see that it is not only focusing on one particular segment, that is individual, but it's also focusing on the group side as well. If you could move to the next slide, please. So talking a little more about the products that they're offering. So this is quite a key slide out here, because this basically talks about the VNB margin. So VNB margin is nothing but the profit margin, if I have to talk about in terms of insurance parlance. So if anybody wants to compare, let's say what the profit margin is, so VNB margin is that particular criteria. And VNB margin basically, as I alluded earlier, where HDFC Life realized that going behind premium growth is not the answer. So they need to focus more on going behind profitable growth. So that is where you can see HDFC Life in the second bucket, where it has got a much diversified product mix as compared to all the other peers. So if you look at ICICI Prudential, or if you look at SBI Life, their focus has majorly been towards selling more ULIP products. And ULIP as a product is a low margin product. So that is why you can see in terms of the VNB margin, HDFC Life has got high VNB margins, rather greater than 20% over the last 4 to 5 years. And the major factor for that being its focus more towards pure term products and more towards pure non-par products. This focus has helped HDFC Life in uh, in basically displaying strong VNB margins, and that's the reason while all other uh, private life insurers are also moving their focus more towards high margin products. So they feel that the opportunity in this particular segment is quite high. And as I alluded earlier, in terms of the structural factors, where we saw only 2.8% is the penetration rate, and with the favorable demographics, they feel that non-participating products as well as term life has become crucial. Even with the pandemic right now, people have realized that having the importance of insurance, and that is where they've already been, HDFC Life has already positioned itself with products that the clients or the customers require. And that has helped it gain VNB margin. Uh, So coming towards the distribution. So as I spoke about HDFC Life having a diversified distribution mix, and this has been able to support HDFC's balanced product mix. So bancassurance is one of the leading channels which contributed close to 55% on an individual premium basis. So HDFC Life has got close to 220 bancassurance partners, of which HDFC Life contributes significantly, through which it sells ULIP products as well as PAR products. And it has also started selling non-PAR savings products. So as you're seeing that the interest rates are low. So that is why these non-par saving products have become quite attractive if I look at with other investment in- instruments available. So currently we are seeing the focus shift for all private insurers towards more non-participating products. And HDFC Life has been able to push non-participating products for HDFC Life as well. However, HDFC Bank has an open architecture, so it does not only sell HDFC Life's products, it also sells Aditya Birla Sun Life as well as Tata AIA. And that is where the need for HDFC Life to not be dependent on HDFC Bank arises. And it's because of this reason, as well as its need to uh, evolve itself as a digital player, has are the key reasons why HDFC Life is spending very high in terms of their own proprietary channels. They've also, as I spoke earlier, that they're also developing new particular avenues through tie-ups with Airtel or with Uber. So wherein, let's say you go for a recharge and you might get an insurance pop-up asking for life insurance. So these are quite fast-growing channels wherein HDFC Life has developed a product for these particular ecosystems, as well as they're getting good response through these ecosystems. So this is not only helping penetrate at in areas where probably you would require people through their agency channel to go, but these particular channels are also able to penetrate the rural market where the penetration level is even higher as compared to the urban market. So these are certain areas wherein HDFC Life is focusing, and because of this diversified mix, so uh, it basically is able to withstand any shock if in terms of there being from the side of the HDFC Bank. So that is the strategy which the HDFC Life has adopted. Mang, if you could put the next slide, please. So this is, as I was talking about embedded value. So for those who aren't familiar with embedded value, so insurance is a long-term business. This basically means you are buying a policy today, but you continue to pay premium for several years. And it is from this future income that the insurer actually makes profit. So the value of a life insurance company is basically assessed by the profits that the business is able to generate from the future cash flow. So this is basically captured by the embedded value. So this is a term that we used in life insurance, and this basically talks about the book value of life insurance. So HDFC Life's embedded value has compounded at a strong rate of about 19% CAGR over FY 15 to 20. And currently, as of the first half, the embedded value stands close to about 23,300 crore. So the primary drivers of this growth has been the surge in the new business, as we've seen in the previous slides, as well as the returns that they've obtained from selling the high margin products in terms of the non-par savings as well as the term insurance. So we've seen that HDFC Life has shown a consistent performance in terms of growth. And this basically indicates the stability that HDFC Life offers. So another key factor, as you all know, that embedded value, it basically involves quite a lot of actuarial sciences. So wherein every insurance company needs to take certain assumptions. In order to judge whether the figures that these life insurance companies are showing, whether these are of good quality or not. So what we in the insurance parlance or as analysts, what we check is the quality of embedded value. So in order to check that, what we do is we check the assumption changes, we check the operating variances. So these are certain factors through which one could know that the assumptions taken by the insurance company, whether it's been quite aggressive or it's been on the conservative side. So as you'll see that operating variance is basically positive for HDFC Life. This basically tells us, or this basically shows or tells us that HDFC Life has been quite conservative when it comes to the operating assumptions that they have taken, and the actual outcome that has happened has been much better than what they had expected a year before. So this gives quite comfort in terms of the HDFC Life's book value also, because this basically helps as us as investors to have perfect confidence on HDFC Life, because they are not being aggressive in their assumptions, and this has helped them increase their EV. So this is a very small component, but this basically gives confidence to investors in terms of stability. Uh, so these are the certain key factors which basically uh, gives us strong conviction that HDFC Life will stand out among the private players, and with the structural drivers that are currently available, as well as the pandemic induced realization within the people that the requirement for not only life insurance but even non-life insurance are key drivers which will help HDFC Life grow in the future.
Thank you, Zubin, for a very in-depth analysis on the life insurance sector and also showcasing the HDFC Life's overall analysis. The hallmark of great asset managers is the quality of research which goes into it, and we're very happy to see the kind of quality you bring in the research space, the way you identify the new trends and you dissect and bisect the companies to really align with the the economic growth as well as the overall portfolio structure. So thanks again, Zubin, for this insightful presentation. And now I open the floor for question and answers. So dear participants, you can type your questions in the Q&A section or the chat box, whatever is suitable to you, and we'll be ready to take them. So dear participants, if you have any questions, you can ask the questions in the chat box or the Q&A section. So Siddharth, one question on behalf of everyone, which a lot of people want to understand is that at this market levels, which are almost like an all-time high, what you will advise to the clients who basically are slightly confused at this juncture, लिए लिए तो भी problem or नहीं लिए तो भी problem kind of a situation. So if you have any pearls of wisdom for our investors and clients.
Very interesting question, I must say, Piyush, because everybody is confused that markets on one fine day are down by down by, in Sensex terms, 700-800 points, sometimes 1,000 points, sometimes 2,000 points, and next 3 days irresistible rally. What should one be doing? What should one be thinking from here? So let me give you a very simple thesis or simple analogy here. So we all understand, I'm sure all your participants are quite savvy as far as the markets are concerned, and they understand that what ultimately drives the equity markets is the earnings, because P multiples can contract or expand due to the liquidity. But what will remain and what is reality is cash EPS. So my perspective is very simple. India has entered into a structural bull run. We have seen that similar kind of bull run from 2004 and 2007. There were spurts of rally and there were intermittent downturn. So people who have been in the equity markets for last 2 decades, they would realize that there was May of 2005 when there was a Black Monday, and there were similar days when the markets corrected, but after that there was a sharp rally. So something like this is going to be witnessed by Indian markets over a next 4 to 5 years time frame. But one thing is very certain, that now India is on the move. So three things have fundamentally happened, because I'm just not going to talk about where the markets would head. There are three things which have fundamentally changed for India. One, the cost base of India for the India incorporation has reduced for good. It's not temporary. It's not because of COVID. The flab, the fat, the excess in the India incorporation has cut down to nearly 60% from 100%. And that cost saving is here to stay. It's not there for the short term. So whilst last quarter, what we witnessed is that the earnings jump came from the cost savings. Those cost savings are gonna be there, but what will happen is now revenues are gonna be shooting up. So this cost saving now and over longer periods of time will mean meaningful jump in the EPS. So that's number one. Number two, clearly the cost of capital or the interest cost on an overall basis, whether secured lending, whether unsecured lending, whether it is business lending, whether it is MSME lending, whether it is wholesale lending, everywhere the cost of lending has come down. The short-term yields have dropped to 2.5, 3% odd. The longer-term yields have dropped to 6%. And that is going to be reality for at least half a decade. Because of the inflation factor, the interest rates at the ground level may inch up by 20 basis, 30 basis, 0.5%. That's about it. But the meaningful drop in the interest rates are going to drive the PAT to the next level. And that's where it will impact the EPS positively. So that's number two, which we are seeing. Third thing, from 2010 onwards, we saw meaningful reforms. So whether it is in the form of RTI, whether we saw in the form of demonetization, whether we saw in the form of GST implementation, all of that, 10 years was the time when India cleaned its act, whether it is in the terms of the corporate governance, whether it is terms of the disclosure of the books of accounts. India has moved to transparent, clean, and ethical business. And that's what is yielding results. So the hard work which Indians, and the community has done over last decade, the result of it will be found in this decade from 20 to 30. And that's why if someone is not investing in equities from a next 36 to a 60 months period, trust me, Piyush, trust me, people will have a bad feeling at the mid of the decade, which is at 2025, that they have missed out something which is very, very meaningful. It is in the first time of the Indian history that the retail participation, the retail exuberance, the retail phenomenon in the Indian equities has been second to none. Sensex originated in 1979. Since then, we have never seen, and never is the word, we have never seen retail participation going beyond 50-55%. Today, the retail participation in the Indian bourses stand nearly between 75 to 80%, which clearly talks about that people here mean business. They want to create their wealth from a longer term perspective. And despite of the fall, we are not seeing that redemptions coming in. People are redeeming from the mutual funds. People are redeeming from the investment portfolios. They are entering directly into equities. Very clearly, because they believe that good quality companies, good businesses are here to stay. So these are some of the trends which we are seeing. And this essentially means that whenever there is a dip of a 700 points, 800 points, 2000 points, just buy. Just buy for next 36 months, just buy for next 60 months, and you will be handsomely rewarded. Last point I just want to talk about is very interesting data point. And this is not the data point which Ambit has researched. This is the research which has been done by a lot of multinational, multi-country organizations. So India currently has 138 crore population, one of the youngest demographics, one of the most sustainable demographics, etc., etc. Urbanization is going to move from 34% to 40% from 2020 to 2030. All those are the facts which everyone knows. But there are two more interesting facts which people don't know. One, India's population is growing at a rate of 1.2% year after year, which means we are adding more people to eat, more people to consume, more aspirational people who want to move from the poverty, from the below poverty line to the lower middle class to the middle class and upper middle class. And this aspirational shift is driving consumption. So for the first time in the history, we have realized the power of this our own country. And what does that mean? Today, when the economy size is closer to 2.8, $2.85 trillion, the discretionary consumption or the discretionary spend is closer to 1.5 trillion dollars. The discretionary spend, it means FMCG, it means industrial, your own discretion, your consumer durables, things which are driven by the people's will, by the people's ability to spend, by the people's desire to have a better well-being and lifestyle. It's at 1.5 trillion dollars when the economy size is 2.85. This number is expected to be $6 trillion, 4x, $6 trillion in next 10 years. 4x in next 10 years. That's the discretionary spend, not driven by exports, not driven by commodity prices, not driven by extraneous factors. Driven by what India has today, what India has now, what is visible. 1.5 trillion moving to $6 trillion. So you can imagine if the discretionary spend is going to become 4x, what will happen to the size of the economy? I'm extremely optimistic by 2030 or 2031, the number of the India's GDP will be somewhere closer to a $10 trillion. And then you can extrapolate what should happen to the Sensex or Nifty. So that's the long answer for your short question, Piyush.
It's a very, very excellent answer actually. And this is number that 4x growth in discretionary spendings is mind boggling. I'm sure a lot of our advisors here would be scratching their heads and trying to figure out their strategies for the coming days with this data point which you shared. It's a great point you made, Siddharth. One question, Mr. Samir Shah from our Calcutta advisory desk is asking is that insurance sales are mainly driven by the tax benefit and all those related areas. That area has still not yet matured beyond a point where people value protection. So in case of government changing any rule on this tax front, maybe the whole party in the insurance sector might get derailed. Any thoughts on that?
Can I answer this, guys? Can I answer this, Zubin?
Sure.
If I have your permission.
Sure, sir.
Okay, so very interesting question that whether insurance sector actually thrives on the tax breaks, or is it the real strength of the insurance sector, right? That's ultimately the moot question which Samir is asking. Now, clearly, this tax break is gone, right? It's out of the window now. ULIPs, the tax break is gone. Very, very clearly, government has already removed this in this budget 2021. The interesting part is, I'm sure there are many expert advisors who are listening to us on this call, and they know what is a balanced fund, right? A balanced fund is very simple. It invests into equity, it invests into debt. 65% up to 65% is into equity, 35% is into debt. And I'm sure there are people who understand the multi-asset class funds also, which invest into debt, gold, and equity. Why am I telling you all this? The reason I'm telling you this is insurance, whether it is ULIP, gives you an extremely good way of mixing both of it. So where the investor does not want to segregate between the life protection, between the amount which he or she should keep aside should anything happens to him or her. So in case of eventuality, the amount should come back to you and an investment. Then this is the right product, and that's what ULIP has now come at a level playing field, as compared to a mutual fund, as compared to a PMS, as compared to a AIF. And most people believe that that is the death of the ULIP. It's not. My philosophy and what I have seen in the past is very simple. When you remove the crutches from someone and inspire someone to run freely on his or her own feet, the person runs better, the person performs better, the person does better. And that's what is going to happen to the insurance sector. The insurance sector, the ULIPs will be sold on merit, not on commissions, not on tax breaks. Very clearly, this was the same analogy which was given by a lot of people when mutual funds removed the entry load. And it is just a decade back, little over a decade back. It is almost 14 years back. I exactly remember 2006, when the announcement came that the upfront set of fees in the mutual funds is gone. 2.25%, which was the entry load in mutual funds, is gone. Everybody believed that mutual funds are staring at their death. Since then, 2006 and today, mutual fund industry has only grown in last 14-15 years. It has only grown 6 to 7x, and that's the power when you remove the crutches. And I'm a firm believer, if with this regulation, the insurance sector is here to rise. So that's number one. Number two, what is going to happen is people will start innovating through the insurance. And what does that mean? Today, ULIP is a plain vanilla product. Will the insurance product manufacturers start thinking about various products where if the person dies, can the instead of paying the lump sum premium, can the family continue to invest into the India's growth story, getting some amount back as the replacement cost and balance money, continuing to grow in the equities, so that over a longer term period, the money which will come back to the family in case of the absence of the main patriarch or the person who has taken the policy, that should be much more significant. Because remember, the biggest risk when the patriarch or the person who's running the house dies, you get lump sum money but you don't know what to do. And that's where, to continue with the India's growth story, there would be multiple such plans which are going to emerge, because as someone said, necessity is the mother of all innovations. And now with the crutches gone for the insurance sector, insurance is even looking much more brighter. The commissions have come down, the costs have come down, the policy rates are absolutely transparent. You can't fleece the customer is completely known. And with the increased transparency, with the increased integrity, with the increased ethics, the sector is only going to grow. So I'm very, very gung-ho on this sector. In fact, this will be one of the biggest sunrise sectors, even faster than banking, in decade of 2020 to 2030.
Very well articulated, Siddharth. I mean, a lot of product innovation is waiting to be happening in this sector, and you really are, so bullish that it really gives me goosebumps when you are in a public forum saying that this could be a faster growing sector than even the banking sector. Amazing, amazing. I think, our participants would be really happy that, this kind of insights are coming out, and it's definitely very enriching, very enriching. So with this, we have almost reached the end of the session. It's almost 5:15, and thanks again, the entire Ambit team, and thank you, Umang, for the initiative which you took and drove us to have this conference. And I thank all the participants again for your time and the patient listening. And thank you, Ambit team, again. With this, actually, we are at the end of the session, so we'll keep engaging with you on a regular basis. Thank you.
Thank you, Piyush, for organizing this wonderful meet. And thank you, participants. Thank you, everyone, for taking time out. It was lovely having you here. Next time, we will present with a new sector which Piyush and the entire team wishes to hear. We believe that knowledge is the best way to spread your wisdom. Whatever we learn, we are here to express and we are happy to share. Thank you so much, gentlemen and ladies.
Thank you. Thank you all.